Welcome to our deep dive on the zero-down dilemma, where we unpack why renting might beat buying, even when you have access to a powerful VA loan. We'll explore the real math behind homeownership, the opportunity cost of renting, and a strategic wealth hack that changes the game. Let's transition into today's agenda so you can see exactly what we'll cover. Here's the plan for this video. First, we will break down the VA loan edge versus reality. Next, we'll decode the true cost of ownership by unpacking PITI plus maintenance. After that, we'll examine the underrated advantages of renting and then look at a real number comparison. We will follow with a powerful wealth hack using multi-unit properties. And we will make the decision visual with diagrams and test your understanding with quick quizzes. Finally, we'll close with an actionable checklist. Let's proceed with a quick disclaimer. Before we start, this is educational content and not financial, legal, or tax advice. Interest rates, property taxes, insurance premiums, VA funding fees, and market conditions vary widely by time and locations. You should run your own numbers based on your situation and consider speaking with a qualified, fiduciary advisor. With that said, let's move into the VA loan edge versus the real costs you'll carry after closing. Let's balance the VA loan's advantage with reality. The major benefits are 0% down and no PMI, which dramatically reduces the upfront cost. However, after you close, your monthly outflow is typically driven by PITI, principal, interest, taxes, and insurance. When you add realistic maintenance, often budgeted at around 1% of the home's value per year, the total can exceed comparable rent. This is particularly true in higher-priced or rapidly appreciating tax districts. Meanwhile, buying also shifts market risk and repair risk fully onto you. In some cases, costs may be similar to rent, but often they are higher, limiting flexibility. Next, let's quantify PITI plus maintenance so you can compare apples to apples. Here's the structure to evaluate total housing cost. PITI plus maintenance equals principal and interest, property taxes, home insurance, and maintenance. For an illustrative $450,000 purchase, at an example 6.75% APR, principal and interest are about $2,916 per month. Property taxes at 1.1% per year are about $413 monthly. Insurance at 0.5% per year is around $188 monthly. Maintenance, budgeted at 1% per year, adds roughly $375. Altogether, this totals approximately $3,892 per month. If your comfortable rent is $2,500, the ownership outflow may be more than $1,300 higher each month. Remember to include potential HOA dues, utility differences, and any VA funding fee impact. Now let's contrast renting and buying at a high level before we dive into a numerical table. Here's the big picture comparison. Renting often provides lower and more predictable monthly outflows, along with mobility, because you are not facing agent commissions and other selling costs if you need to move. The savings relative to owning can be deployed into investments. Your landlord typically handles major repairs. Buying, on the other hand, creates forced savings through principal paydown and offers potential, but not guaranteed, appreciation. However, you take on maintenance responsibilities, exposure to tax increases, and repair risks. When you exit, transaction costs can be substantial, often around 6% of the sale price. With that context, let's turn to a concrete table and run the numbers side by side. This table frames the trade-off. If renting is $2,500 and ownership totals between $3,300 and $3,900 or more, the gap ranges from $800 to $1,400 monthly. If instead of spending that gap, you invest it at a 7% annual rate for 5 years, the future value can range roughly from $45,000 to $80,000, depending on the exact gap in returns. Additionally, consider selling costs. At 6% of a $450,000 sale price, that's about $27,000, which reduces net proceeds. With the baseline trade-off clear, let's introduce a powerful alternative that can flip the math in your favor. A compelling alternative is to apply the zero-down benefit to a small multi-unit property, such as a duplex or triplex. By living in one unit and renting the others, you can offset a large portion of your monthly PITI plus maintenance. For example, with an illustrative $400,000 duplex, where total monthly cost is around $3,400, if the other unit rents for approximately $1,800, your effective personal housing cost falls to roughly $1,600. That undercuts a $2,500 rental while still building equity. Success here depends on disciplined tenant screening, budgeting for vacancies, and maintaining reserves. And as operations stabilize, consider whether professional management makes sense. Next, let's visualize where the money actually goes each month when you own. This pie chart displays the composition of a representative monthly ownership cost on a $450,000 home. Principal and interest is the largest slice. Property taxes and insurance together form a meaningful share. Maintenance, while often overlooked, is a persistent expense and should be budgeted monthly to avoid cash flow shocks. Having seen the cost structure, let's step back and map a decision process to help you choose between renting, buying, or house hacking. This mind map begins at the central concept, your housing decision, and branches into three options: renting, buying a single-family home, or house hacking a multi-unit property. The rent branch highlights lower monthly outflow, greater flexibility, and the ability to invest the difference. The single-family buy branch emphasizes that PITI plus maintenance often exceeds rent, with equity gained via principal, but with exposure to market and repair risk, and significant exit costs. The house hack branch shows how rents from other units can offset costs, while reminding you of landlord responsibilities and vacancy risk, with the potential for faster equity growth and cash flow. Around these branches are cues. Compare total cost to rent, assess job stability, analyze local capitalization rates, and consider whether your time horizon exceeds 5 years. With the framework set, let's test your understanding with a quick quiz. Quiz time. Which items belong in a realistic monthly ownership comparison against rent? Option A, only principal and interest. Option B, PITI plus a 1% per year maintenance budget. Option C, property taxes but not insurance. Option D, only utilities and HOA. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is PITI plus a 1% per year maintenance budget. To compare properly with rent, include principal and interest, taxes, insurance, and a realistic maintenance reserve. This gives a truer monthly outflow. Next, let's try one more quick scenario question to solidify the concept. Here's the scenario. If renting costs $2,500 and owning costs $3,400, what is a smart move for long-term wealth in an uncertain market? Option A, buy anyway for forced savings. Option B, rent and invest the $900 difference monthly. Option C, wait and hold cash under a mattress. Option D, ignore maintenance and buy now. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The best answer is to rent and invest the $900 difference monthly. This approach preserves flexibility and leverages compounding, particularly when home equity can be eroded by selling costs and market volatility. Of course, this depends on your discipline to consistently invest the gap. Now let's distill the most important lessons into a short list. Here are the key takeaways. First, always compare rent to the full cost of ownership, including maintenance. Second, renting can free up cash for investing and preserve your mobility. Third, transaction costs and market swings can meaningfully offset equity gains. And fourth, a zero-down approach can be powerful when applied to a multi-unit house hack that reduces your effective housing expense. With those in mind, let's summarize and give you a simple checklist you can use right away. To wrap up, calculate your PITI plus maintenance and compare directly to a sustainable rent. If owning costs more, consider automating investments with the difference. Evaluate whether a duplex or triplex house hack can convert your housing into a cash-flowing asset. Finally, revisit your numbers annually because rates, property taxes, insurance, and local rents change over time. As we close, I have one creative request for you. Thank you for watching. If you found this valuable, please like the video, share it with someone who needs this perspective, and subscribe for more data-driven money decisions. I want to hear from you. Are you leaning toward renting, buying, or house hacking? Share your plan and your numbers in the comments so we can learn together.